let's just cut right through all the noise. Today, we're going to break down a swing trading strategy that is so simple, it literally just relies on a single line. But don't let that fool you. This method has been a cornerstone for professional traders for decades, and we're about to see exactly why.
You know that feeling when you're staring at a chart with like a dozen different indicators and you're just totally overwhelmed? Yeah. If that's you, you are in the right place. We're getting rid of all that confusion today.
So, what if you could trade with just one line on your chart? Well, that's the promise today. We're focusing on a strategy that's built on crystal clear, repeatable rules that can lead to some really powerful results. And hey, make sure you stick around because at the end, I'm going to share a pro tip that might just change the way you look at trends forever.
All right, so with hundreds of indicators out there, why build an entire strategy around just this one? The 50 EMA? What makes this one line so special? Let's dive in.
See, the 50 EMA isn't just some random line. It represents the average price over the last 50 trading days, which is about 2 months of market action. Now, here's the crucial part. This is a key time frame for big institutions. It's kind of like their sweet spot for building or getting out of huge positions without shocking the market. So this line becomes our guidepost for where the big money is playing.
This right here, this is the secret sauce of the whole strategy. When a stock is in a strong trend, the price treats this line like a magnet. It'll pull back to it and then bounce right off. Think of it as a moving floor in an uptrend or a moving ceiling in a downtrend. It's this exact behavior that makes it so important for the big institutional players, the huge funds, to keep a close eye on.
Next up, let's get our charts set up. And trust me, you're going to be surprised at how easy this is.
Okay, here's everything you need. Seriously, that's it. We're using the daily chart. That's our sweet spot for swing trading. The only indicator you're going to add is the 50 EMA. That's it. Now, you want to focus on large cap and strong mid cap stocks because that's where the institutions are. And please stay away from penny stocks. They're just way too unpredictable for this. Oh, and for an extra layer of confidence, you can just glance at the weekly chart to confirm the bigger overall trend. Simple, right?
All right, now for the fun part, the actual strategy. We'll kick things off with the bullish setup. This is how we pinpoint those high-probability buying opportunities in a stock that's already moving up. This is a 4-step process, and the order is absolutely critical. First, the price has to be trading above the 50 EMA. Second, the EMA line itself needs to be pointing up, showing us that momentum. Third, and this is where your patience comes in, you wait for the price to dip down and test that 50 EMA. And finally, you look for that confirmation candle that screams, okay, the buyers are stepping back in. So what does that confirmation actually look like? Well, you're hunting for specific candle patterns right there at the 50 EMA. Something like a bullish engulfing candle or a hammer or even just a big, strong green candle that closes near its high. These are all signals that the pullback is probably over and that the main uptrend is ready to get going again. So here's the full game plan. You enter the trade when the price breaks above the high of that confirmation candle. Your stop loss, your safety net, goes just below the most recent dip, that little swing low. And your target? You're aiming for the last major peak, the previous swing high. What's awesome about this structure is that it often sets you up for a fantastic risk-to-reward ratio, sometimes 1 to 2 or even better. Of course, markets don't only go up. And the beauty of this strategy is that it works just as well in reverse. So let's flip the script and look at how to use the exact same logic to profit when a stock is heading down.
And notice how this is a perfect mirror image of the buy setup. It's the same exact logic, just upside down. 1, the price is below the 50 EMA. 2, the EMA is sloping down. 3, you wait for a little bounce, a rally up to the 50 EMA. And 4, you watch for a strong bearish candle to signal that the sellers are taking back control.
For a sell setup, your confirmation signals are things like a bearish engulfing candle, where a big red candle just swallows the previous green one, or a shooting star. That's a candle that shows buyers tried to push the price up but got slammed back down. These are powerful signs of rejection right at that key 50 EMA level. The bearish trade plan follows the same logic. You enter a short trade once the price breaks below the low of that confirmation candle. Your stop loss goes just above the recent peak. And your profit target? You're aiming for the last major price level where buyers had stepped in before, that previous support zone. So let's just recap real quick. In an uptrend, the 50 EMA acts as your support. It's a floor. You're looking to buy the dip. In a downtrend, the 50 EMA is your resistance. It's a ceiling.
you're looking to sell the rally. The logic is perfectly symmetrical, which makes this whole strategy really easy to remember and use consistently. Okay, so knowing the rules is one thing, but applying them like a professional is something else entirely. This next part is all about the discipline and avoiding the common mistakes that really separate the consistently profitable traders from, well, everyone else. Now, this is so important. This strategy only works in a trending market. So, if the 50 EMA is flat and just going sideways, you do nothing. You just stay away. A flat line means the market has no direction. The biggest mistake people make is getting impatient. They trade every single time the price touches the EMA instead of waiting for a clear confirmation candle. Remember this. Patience is your real edge.
All right, as promised, here it is, the pro tip. This is a subtle observation that can help you spot when a trend isn't just strong, but it's potentially getting ready for a truly explosive move. Start keeping an eye out for this pattern. A stock pulls back and bounces off the 50 EMA once. Then it does it again, that's twice, and then a third time. This is basically showing you that buyers are aggressively defending that level. And very, very often, it's that fourth test and bounce that leads to the most powerful, explosive move of the entire trend. And this brings us to a really critical mindset shift. You do not need to trade every single day to be successful. Your goal isn't to be busy, it's to be profitable. Finding just 3 or 4 high-quality setups like this a month is more than enough to grow your account consistently. It's all about quality, not quantity. But before you place a single trade, you have to internalize this next part. No strategy is foolproof. Even the most perfect A+ setup can fail. So your number one job as a trader isn't to make money, it's to protect the capital you already have. And this is how you do it. This is the golden rule of risk management. No matter how confident you are in a trade, you should never ever risk more than 1 to 2% of your total trading capital on that one idea. This rule ensures that a few losing trades won't wipe you out, and it keeps you in the game long enough to actually succeed. So there you have it, a complete, rule-based strategy from start to finish. The information is all yours now. The only question that's left is whether you have the discipline and the patience to wait for those perfect setups and execute the plan without hesitation, because ultimately, that's what makes all the difference.